All right, welcome back, episode 14. We have Elijah Brown on today, and this one's going to be awesome. Elijah has acquired interest in over 1,500 apartment units valued at over $300 million. You're going to want to listen to this. We're going to get started right now. I'll wrap on the next one. Episode 15, I wrap. All right.
I'm Nick Good. I'm from the hood.
Yeah.
You know where
That's why they call me Good.
Get some wood.
Yeah. All right. Welcome back to episode 14 of the More Doors podcast. Today we're going to have a great show. We have Elijah Brown on. Elijah has acquired interest in over 1,500 apartment units that is now valued at over $300 million. So he probably knows what he's talking about. And he gets to travel the world in some kind of van.
The Mercedes van.
The Mercedes
van.
van.
It's not just any van.
Yeah, it's down by the river. So we're excited to have Elijah on, but today's episode is brought to you by Deep Blue Capital. Look, you want to grow your money. You want to see where the smart players are putting their money? Then you need to go over to deepbluere.com and see about how you can grow your wealth, how you can defer your taxes. Brian and I just got back from a tax deferring class today, and there's a lot of things that were like, look, Deep Blue's already doing that. So all you need to do is go to deepbluere.com, sign up for the newsletter. You can see what deals that Deep Blue is analyzing, what projects they have coming up in the future, and what they've already closed on. So we'd be excited for you to go over there and just give a little bit of your information over there. And if you liked this show, which hopefully you do because you're listening to this, you just need to go and leave us a review on any of the podcast channels, subscribe to our YouTube channel, leave some comments on there. You know, Matt does a lot of work. Matt is the social media guy. That's his job title, social media guy.
Cool.
He's doing great.
He's doing awesome. He does the reels. He dances in them.
I do.
He does dance.
Yeah,
I rap.
all
I
the
rap.
trendy reels.
Do you want to see a video of me and Matt really fast? This is totally.
I don't think we can do this.
Oh
I'm
boy.
gonna show you this. This is going to be for the live viewers on the podcast. That they won't see it. So if you're listening right now, you're just going to have to just trust that this shit was hysterical.
Actually,
we
go to
were
YouTube.
hanging out the other day, and I was definitely sober. This is Matt. Matt was making dinner.
Oh, I did see this one. Yeah, here's what we'll do. He's doing something
I'm chopping.
very fast. He's chopping. We'll send that out. Once you sign up to deepbluere.com, we'll send that video out to you. So you want to take a look at that. And then, of course, Tor Studios. Go to torstudios.com if you want to.
TORE.
Yep, if you want to build out a podcast or any video marketing branding to reach out your potential clients and customers. So, all right, let's bring Elijah in. I'm going to read his bio, but then I want him to go a little bit deep on this because I'm going to tell you,
Because you don't know how to read?
I don't know how to read, but secretly I have a desire to travel the world in a van. That's all I follow on Instagram.
Van life?
Really?
Van life stuff.
Are you kidding?
No, I'm not. 100%.
Really?
I want to van life it. I am so jealous. I just want to van life it. Heather won't let me. She's like, "How are we going to get 3 kids in a mother-in-law and a van?"
Nick's like, I'll figure it out.
Yeah.
I didn't say the kids were
I didn't say how big the van could be.
Exactly. But I'm super interested to hear this. But look, Elijah began his real estate career as an employee for a large real estate investment trust called Healthpeak Properties. And during that time at Healthpeak, Elijah developed a strong foundation in financial modeling, playing a key role in over $4 billion of transaction volume. So that's a lot.
Yeah, it is.
Billion with a B.
With a B?
Yes, with a B.
$1 billion.
$1 billion. So in 2017, Elijah co-founded GoldHawk Capital, a real estate investment firm focused on acquiring multifamily properties across the United States. And through a combination of ownership structures, Elijah has acquired interest in over 1,500 apartments valued at over $300 million. That's million with an M.
Thank you.
Yep. So in addition to real estate, Elijah serves as a civil affairs officer in the United States Army Reserve and was previously a military intelligence officer. And Elijah has received numerous leadership awards during his time in the military. And last, as Elijah has received his bachelor's degree in business from the University of Southern California, and he travels the world full-time in his self-converted camper van. That's my favorite part of the whole bio.
Hold on. I'm sorry. Before we bring you on, how do you travel the world in a van? Can't it just be?
You
the
can drive
US?
from South America to North America.
That's true.
And I hear they're going to build a bridge from Alaska to Russia soon.
Okay,
Yes.
well then there you go. That's
So there you
pretty much
go.
all I need.
Problem
All right.
solved.
I
You're welcome.
apologize.
Yeah, welcome, Elijah.
Thanks, guys. Oh my goodness. This is the most insane group. I've been on a lot of podcasts this year, and you guys are by far the most entertaining and exciting. So thanks for having me on. I appreciate it. This is going to be an awesome conversation.
Why be stereotypical?
Exactly. Look, the market's tough right now, Elijah. We got to have fun.
That's it.
Right? Yeah,
That's right.
Yeah, I mean, we're looking at deals. We're all in deals that maybe not going the best right now. So we got to have some fun with all
You're
this.
about to
Not
overpay
all of
for
us.
one, so you better
Yeah.
make up for it with a good podcast episode.
Exactly.
Yeah, 100%.
Exactly.
So Elijah, again, we just went over that bio, which sounds awesome, but tell us a little bit more just about yourself. I like to expand that you're Army intelligence officer, so obviously you're not a stupid person, right? That you've got to.
Oh my God.
Military intelligence, the key word being military. And for anyone who has had any experience with Army, military, anything, it breeds stupidity. There's a lot of smart people in the military, but for the most part, it's just it's where people go for, safe, stable, secure jobs and getting out of bad situations. And for me, it was paying for college. They wrote me a $400,000 check. Got to go to the University of Southern California for free, graduated with no debt, and that really helped me with my career. But I got into intelligence because I originally wanted to be a pilot. I wanted to fly Black Hawk and Apaches or whatever, be really cool. And I found out that I would have to go to a school for 2 years straight and then start an 8-year contract after that. And I said, hell no, I'm not doing that. So I went to Intel, which was a bit less of a commitment.
Wow.
Did you meet David Goggins or Jocko or any of those guys?
I really like those guys. I think they're super motivational. Didn't meet them, never got to that level with my career.
Yeah.
I was always focused more on real estate and building my civilian career out more so than military. So
Yeah.
I actually started in the reserves. I never went active duty.
All right. Well,
It's a
thanks
hell
for
of a- I
thanks
mean,
for your service, regardless. That's
appreciate it.
awesome.
It's a hell of a path, man.
Absolutely.
I mean, my father took a very similar path in the Air Force. They paid for Notre Dame, and
Yep.
he was able to graduate with no debt. He did have to go to war, unfortunately, but he
Tom's a
came back.
badass.
Yeah, he did.
He is
cool guy.
certified badass.
Certified.
And he's fun to party with.
He's very fun to party with.
Like all the military guys, right? So Elijah, you had was the intention to get in real estate from day one, or kind of walk us through your real estate journey there?
Nah, man, I wanted to trade stocks for a living. I was doing penny stock pump and dumps when I was 14 years old.
Me too. That was fun. Yeah.
Got an illegal trading account because I wasn't
I didn't do
18.
that.
Had to get my dad to sign it and whatever.
Nice.
That didn't really work out. I tried doing currency trading. I actually made a little bit of money doing that, but that's a whole nother a whole nother podcast for that. And I ended up getting I got an internship at a hedge fund, which was awesome because I was going down investment banking, recruitment pipelines, trying to figure out what the best path was to get rich fast. And I thought it was investment banking, and then I got a job at a hedge fund, and that was whoa, I can just skip 2 to 4 years and kind of just fast track this journey. Well, a few months into that internship, I was fuck this. I am not trading stocks. I'm not gonna be up in the middle of the night trying to short something stupid and take a whole bunch of risk. And I started watching a lot of YouTube videos, and I fell down this rabbit hole watching Bigger Pockets, Graham Stephan, Chris Crone, Phil Pustajovsky, just a few of the awesome real estate YouTube guys. And I made a decision after watching 2 weeks worth of videos. I just said, it's time. I'm done with the education. Time to go buy my first rental property. And that was it.
Wow.
Nice. Tell us about the first one, if you don't mind.
Yeah. So the first one, I actually ended up paying a consulting agency $4,000 to kind of hold my hand and walk me through that first deal. It was pretty much turnkey buy your first rental service. And it was a horrible deal. Should have lost money. We made $30,000 because the market was so hot. But it was just horrible. I had to make officer loans. It's just like there was never cash flow. So it was overall like a bad deal, but I'm so happy that I bought it because, even if I had lost money, it would have been worth that educational experience, getting started, because now I've got a big portfolio and I wouldn't have had that.
Yeah.
Let me ask you this, because you hear a lot about people, when they're going, they want to go down the path of just investing, and on their first ones, it's all about the experience, right? It's the education piece. But let's say that you would, instead of, if the market wasn't hot and you had to hold that and you're writing that check and then you sell it for a pretty big loss just to get rid of the headache, would that have derailed you to continue forward on your real estate investing journey? Do you think that would have stopped you in the tracks, or do you think you would have kept going?
No, it would not have. I would have kept going. The reason why is because by the time I went to go sell that property, I had already accumulated quite a number of doors. And so that property was such like a small portion of my portfolio after a few years that it really didn't matter. I would have sold it for a loss. Honestly, I probably wouldn't have sold it for a loss. I probably would have just held on to it and floated it for as long as possible. The longer you get into it, you keep raising the rent's $50, $100 every year, but the mortgage payment stays the same. And so eventually it starts to cash flow. And so I probably would have just held on to it until the market was hot enough to sell.
Sure. But in the meantime, you started to accumulate more doors podcast. Did you? I think that the big thing for like really beginning investors, or maybe people that are just learning about investing, is like you pulled the trigger finally, you did the first deal, even though it didn't go exactly how you had planned, you realize that the world didn't fall apart either, right? And you're able to think strategically and work through problems, and then it just makes you like, even if your first deal isn't a home run, you go like, oh my gosh, like I'm still standing. Let's go do more.
Yeah.
You just get
Figure it
addicted
out.
to it. Yeah,
Exactly.
you just get addicted to figuring it out.
Real estate can be forgiving over time, right? As Elijah was saying, like the rents go up, your mortgage stays the same, and unless you're in Texas, your property taxes typically stay relatively fixed, and you just hang on to it long enough, and it works out.
You have time to make decisions. In the hedge fund world,
no,
you can become long-term capital real
trading
fast.
for eighths and quarters.
Yeah.
All day.
Yeah, exactly.
So you do the first deal, single family, it sounds like. When do you decide to make the jump into multifamily?
It took a few years. So I ended up getting that job out of school at the REIT, Healthpeak Properties. And the guy who hired me was kind of a mentor, and he pulled me aside after a few years. Actually, I pulled him aside, and we were discussing my portfolio and what I was doing, on the side on nights and weekends. And he was like, "Hey man, you're going to need like 50 to 100 doors just to like make any money doing this." And I'm like, "Oh man, that's a lot of single family properties, a lot of closings, renovations, dealing with horrible property managers, raising money, the whole thing." So he convinced me to scale into multifamily, and that was like the best advice ever. So I went and did it.
Nice. I'm surprised Nick didn't whip out his calculator, because we've had this conversation a couple times, and he tells you how many deals you need to buy a year and how many years it's going to take you to make $300,000.
The single families, your cash flow maybe $100, $200. It's like not worth it. So.
I mean, it's how defeating is it, right? So like you go to all these seminars, you read some books, and they make it sound amazing in those books, like, I'm going to be able to get out of the rat race. I'm going to be able to retire. You start selling it to your family or to yourself, and then you go buy your first one, and you're like, oh, shit. Yeah. I'm losing $200. I got to work harder now, and now I've got more responsibilities. And then you start finding, like you said, Elijah, these $100 to $200. I mean, I can't live off $200 a month. And
it's like one thing happens, like the roof needs to be replaced, or the water heater, and it's like, shit, there goes my whole year. I'm like,
exactly.
Oh God,
exactly.
not worth it.
But you have tax write-offs, Elijah. It's tax savings.
Yeah.
Tax savings. Yeah. Remember.
That's true. But on really small, like single family properties and stuff, it's not even worth it to do a cost segregation study. And so you don't even get like full tax benefits from that. So
100%.
Nice. So tell us about your first deal as you go into multifamily.
Yeah, it was a sixplex, absolute dumpster fire. I write about it on LinkedIn all the time. This thing was like $330,000. It's in Orlando, Florida, in like one of the bad neighborhoods. Nice. And actually found it on LoopNet of all places, like the
Sounds
graveyard, the graveyard of real estate. And I was like, well, I'm willing to put in the work that nobody else is. And I put a little deck together. I think it was just like even a Word document, like a 4-page Word document. And I walked around and pitched it to all my coworkers, all my friends at work, and got like 10 people to each put in like $10,000. And that was it. That's all we needed to get in on it.
Wow.
Nice.
Wow.
And where were you living at the time? So this is, you bought in Orlando, Florida. Were you there in Florida?
No, we were in Orange County, California. So
yeah, so all the way across the globe, or the country.
Get this. So I wanted to save money on due diligence, so I took a red-eye flight there. So like ended up like arriving at like 6 a.m., did the property tour, and then flew out same day so I wouldn't have to pay $200 for a hotel room.
Oh my gosh. Whoa.
Scrappy.
All the way to Florida and back. Yeah, I slept on the plane. It was horrible.
So what was your pitch though? Again, you guys, you and your 10 coworkers, they're there in California, going to invest in something in Florida that's, a 4-hour flight away. How did you pitch them on that?
Yeah, so I did an underwriting model. Again, my background coming from that space was cash flow modeling. So put that together, realized it was a good opportunity if we could execute it well. Then I wrote up all the details, the business plan, essentially, pretty much the investment deck, and then I just walked around and pitched it. I said like, hey, like I'm putting deals together, and I had done 4 single family before that. So I had gotten some of those guys in on those deals as well. But really at this point is just friends, family, and coworkers. So people who already trusted me when I really didn't have a track record or the experience.
Yeah, 100%. How did you, I guess, like you said, dumpster fire, right? Like there is riches in for people that are willing to take risks, right? I never heard this Will Crozier quote before today, right? But like you get rich by taking big risks with small amount of money, and you stay rich by taking small risks with large amount of money, right? How did you manage a project from the West Coast to actually execute your business plan and mitigate the risk of buying a dumpster fire?
Yeah, I think we went through like 3 different property managers. It was pretty bad because they lie, cheat, and steal, and everything under the sun. We went through 2 or 3 different contractors as well, and they all come from like referrals from the brokers and the property managers. Everybody kind of is in bed with each other, so they all refer their friends. And it was a bad experience. Actually, you know what? Almost all of my active deals have been tumultuous and horrible experiences, and
and yet you keep doing it.
You know what? It's the people who are willing to like deal with the shit who end up successful. So I
hear you.
100%.
It's all. I think Elijah said it before, right? It's all about the people that are willing to do the work that others aren't.
Yep.
And that's how you separate yourself, right? Just to go from 0 to 1. Right, Peter Thiel's book, 0 to 1. Yep. It just takes a different kind of mental state, right? Kind of a mindset, and I mean, I really what Elijah said about the first one really resonates with me. As soon as you do the first one, though, the floodgates open. Whether that's a single family, I bought my first single family and then bought my second in like 10 weeks later, right? And then my first multifamily, like open up the floodgates, and you just got to keep doing it. At some point, the pain and the inconvenience and the problems, you just get numb to it, right? After the second or third one, you're like, oh, fuck, another water heater.
It still sucks.
Whatever.
Yeah, exactly. You only go through so many of the same types of problems. You don't become numb to it, but you become smarter.
You just have a Rolodex of people that can handle it.
Yeah.
Yes.
You just, now we
There's
know
always
exactly.
new problems.
Exactly. Right?
Always.
Like,
Can we say more money, more problems here? Can we do that?
It's unbelievable to me how many calls I get on with people like thinking they're gonna go like do their own deal, and they think it's passive income. They're like, "Oh, I read in this book, like I can get passive income too." And I'm like, "Buddy, you have no idea what you're about to do. This is you're about to take on a second full-time job. So like, just so you know, if you don't want to do that, I've got options. But if you're really trying to get 100% rate of return, you can do it. It's going to be miserable for like 5 or 10 years.
So so you bought the sixplex. How did it work out?
Worked out really well. We hit 60% IRR after 3 years on that.
Whoa.
Yeah.
So would you sell it for 600?
We sold it for almost 7.
Wow.
Yeah.
In 3 years?
Yeah.
That's fantastic.
Ka-ching.
Yeah. So we doubled the value. Essentially, we spent I think $15,000 per unit renovating it, real builder grade crappy renovation. But that allowed us to significantly increase the rents, and the cap rates also came down about 3 to 4%, which was insane. And
Wow.
then the valuation was just a lot higher when we went to sell.
So when was that?
Yeah, bought it in 2019, sold it last year.
All right, so let's put that in perspective for everybody, right? Elijah buys his first sixplex in 2019. So I'm not the best at math, but that sounds like 4 years, right? 4. Yeah, okay, good. And he sold it last year, so that means he held it for 3. See, I'm doing good now. Doubled the money, right? And now you have raised, or you have a portfolio of 1,500 units at $300 million. And I'm sure there's somebody out there that's like, he's an overnight success. No, he's not. It's taken him a while. But tell us about how you take that first deal and learn from it and then scale so significantly in a short period of time.
Yeah, after doing a few of those really small multifamily deals, I realized that I myself would not be able to essentially personally scale the portfolio as much as I wanted to, mostly because of capital raising constraints, but also key principal requirements. Like you got to have a high net worth to be able to sign on large loans, and then also getting access to incredible deals. Typically, you got to prove that you can close. It's kind of like a catch-22. If you can't prove that you can close, you can't get the deal. But the brokers aren't going to show you the deals unless you have closed before. So It's like, how do you get in on that thing? What I realized is that I needed to partner with someone who had the track record and the experience and the resources needed to get into these much larger deals. And so after those first few small multifamily deals, all of the rest of the deals that I did have been partnering with much larger companies that were already going out and doing these much larger deals. And I would play a smaller role. I would play a role on their team in exchange for, a piece of the general partnership.
Gotcha. So, are you raising capital, or are you more of the asset management and deal execution team?
Capital raising now. So my entire business now, I've essentially sold off most of my active deals, and I am now mostly a passive investor, a limited partner, and I also run a fund of funds, which is my primary business, where I allow limited partners or other passive investors to invest alongside me within a separate LLC. And so essentially what we do is we pool large sums of money together from other investors plus my own capital, and we take that $1 million or $2 million to someone who's putting a deal together, and we say, I've got a large check for you, but I want to keep more of the profit at the end of the deal. I want better terms. And so we invest that capital into the deal, we get better terms, and then everybody in my LLC ends up happy. That's how we do it now.
That's really cool.
Yeah, so an LP can really, really just kind of pour gasoline on.
And you said you like deals in Dallas?
Yeah, we love Dallas.
So do we.
What's your track record?
Pretty good.
Pretty darn good.
Pretty darn good.
Yeah.
Awesome. Send me the materials.
See that?
Love it.
Love it.
Love it. Love it.
All right, podcast over. Thanks, everybody. Bye.
So how did that? That's obviously a totally different sort of venture, and I assume after you had a few active GP deals, it was easier to start kind of a different strategy. But what was it about taking, a more passive role in the deals, but also having a completely kind of separate business that you're able to, really work on and still help other LPs increase their returns. Like, where did that mindset come in, and how did you go, okay, here's how I'm going to start this business?
I realized that I had to focus on what I was best at to essentially scale the most. I make the most amount of money for the amount of time I spend when I'm raising capital.
Yeah.
And so me providing like an investor relations capital raising type of service to these larger deals is where I fit in the best, and where I am most efficient, where I can provide the most value. So for a while, I was taking GP positions in these deals. I was raising a significant portion of the capital. I was doing underwriting. I was doing asset management. I was providing all these types of values to these larger companies. And then after a while, I realized, I would rather be more on the passive side, and I would rather just be a capital allocator, essentially just like a fund-to-fund structure.
Yeah.
What's the difference, like, from a mentality and stress perspective? But for me, I tend to be a little bit of a control freak.
Yeah.
What?
Shut up, guys.
We're not saying anything. Look, it's good.
And so, like, when we find a deal and raise money for it, like I like to be as hands-on as possible. That's the juice for me, right? And making sure that we deliver on the returns for our investors. Like, what happened to, or how did your thought process change around going from an active sponsorship role to a more passive capital raising type of function?
I realized that other people, by that I mean the larger companies, these private equity funds, they could do the investing part of it, the deal sourcing, the underwriting, the asset management, the renovations, the property management. They could do all that far better than I ever could with just myself and in my current position. And so I thought, if I'm going to scale, I need to outsource all the stuff that other people are better at and just do what I'm best at. And so that's kind of the mindset shift that I had. And I decided I'm just going to provide this one service that I'm really good at. And that's it. And I'll let the professionals handle all of the stuff that keeps me up at night.
Yeah. And I think that's just such a self-aware mindset. I think where people just become so burnt out so quickly is they keep too many things too close to the vest. They can't delegate well, and they just, if somebody can do anything 80% as well as you do, you need to be able to delegate it. Otherwise, you're either your capacity is incredibly limited, or you're gonna hit burnout mode really, really, really quickly in any business.
I could do a deal a month right now. I could do 2 deals a month. Yeah. And before, when I was running the deal, maybe I'd make like 3 or 4 times more, but I could only do like 3 deals a year, and that's it's not really scalable that way.
Yep.
As a capital allocator, right now in this environment that we're in, what are the kind of headwinds that you're facing, with those struggles?
Yeah, it's challenging to raise capital right now. A lot of people are still sitting on the sidelines. They think that there's going to be more blood in the streets before things get better. By that, I mean they think property values will continue to go down and that they won't recover for a long time. And it's just a struggle to convince investors to jump in right now, especially when you got a lot of news coming out about real estate syndicators struggling with their short-term bridge loans with the rate caps expiring, and so it's just a difficult market, but we're doing our best. We're raising consistently a significant amount of money every month, and it's growing. So we're thankful.
What are your personal feelings on all of this? Like in terms of with values dropping and just the overall state of the market, what are your personal beliefs?
I've always been the contrarian. I think right now is the absolute best time that you'll ever have to buy property for the rest of your life. The reason why I think properties right now are, you can get them at a discount. For example, we're buying properties in Dallas at 20 to 30% below what they traded at last year.
Yeah.
And so property values, just because of inflation and rents and supply and demand, they're going to keep going up. You look back at any 10-year period in history and property values, just skyrocket. And especially think about right now, a lot of people are not buying properties because the rates are high. As soon as the rates start coming down, there's going to be a ton of demand, a ton of transaction volume with these properties, and that's going to cause values to shoot through the roof. Cap rates are going to come down, and meanwhile, rents are still going to keep going up because there's such a massive shortage of housing units. And so really it's just the perfect storm for significant appreciation within the next few years. My bet is that by 2025, we'll be back on track with a bull market.
Yeah. I think Elijah's hit it right on the head. Like, I was thinking through kind of a timeline. I saw something on LinkedIn today that mortgage applications are the lowest since 1996. And I'm like, where was I in 1996? I was 18 and didn't give a shit about much. But I remember that, come 2000, right? And then it was a good period of prosperity. And then we had 9/11.
Yeah.
Right? And that messed everything up.
Yeah.
And then we had the credit crunch of 2008, and that messed everything up. So barring those two things, right? I think we're going to be okay on the other side of this thing. And I was looking at some CoStar data on a deal that we're looking at last night, and it shows like there's graphs and stuff. It's unbelievable. Great pictures about the dip really happening in the second half of this year and into next year, and then to Elijah's point, like shooting right back up.
Yeah,
there was 500 or 600 new units set to be delivered in this certain area between now and the middle of 2024, and 0 permits filed for construction after that, right? Like, as soon as those new units are absorbed and we get through the other side of this recession, I think we're going to bounce back pretty darn quick.
Well, we have to, right? Like, I love Elijah's very common sense approach. It's not rocket Scientology, right? It's.
Wait, we can't say Scientology.
Can't say that. No,
they'll come get
Tom
you.
Cruise.
They'll come get
He's
me.
coming.
Tom Cruise is
He's here.
listening.
He's jumping off a motorcycle right now.
Why do you think Elijah's in a van?
You guys,
And he's military
intel,
intelligence, dude,
the
right?
Chinese
He's going
and the
stealth
Russians
mode.
are listening right now.
Exactly.
Better
Elijah,
watch it.
is your van stealth? Be honest.
Is it?
It's like medium stealth. We've got like a big roof deck and solar panels, so probably not.
I mean,
It sounds like pretty stealth. It's like matte black and stealth.
right?
Yeah, it's like the Predator. You can't see it, but it's there.
Exactly, right? But it's to me, there are some very complicated economic environments, right? Especially on a global level. I don't believe this is one of them. I think it's incredible that economists get paid money to even talk about these things. If you look at the multifamily space, for example, it's very simple. Asset prices and cap rates have a directly inverse relationship to the cost of capital, right? When the cost of capital goes up,
In the
asset
short term,
prices and it's just going to be what it is. There are going to be fewer trades, right? And then you add in the inflation component, and rent growth is going to stifle off a little bit. And then what's going to happen? Well, asset prices are going to come down, and that's going to cause, on a macro level, to be a recessionary environment. Then they'll bring rates down, one of the only 2 levers that the Fed has. But in that inflationary, high cost of capital environment, what is also going to happen? Fewer permits are going to be pulled. So you're going to run right into the same inventory shortage 18 to 24 months later, right?
Worse.
And then everything's going to come rushing back, and asset prices will go back up when the cost of capital comes down, right? When it seems most fearful to do something is the time you need to do it, because there's only a brighter future on the other side, right? I think this is a very scary time for a lot of people because it just doesn't feel good to have inflation and rates this high. It's just also not necessarily complex as the fun guys on Wall Street and hedge funds like to make it seem. It's pretty straightforward. You just got to have the whatever to jump in.
The chutzpah.
Yeah, is that what it is?
Guys, one of the reasons why we even buy multifamily in the first place is because we don't have to worry about the near-term ups and downs. It's like,
Right.
as long as you can put on some type of longer-term fixed rate debt product and keep your building relatively occupied, it doesn't matter. You can sit on it for as long as you need to. You don't have to freak out. And so it's one of those things where it's just like very safe. It's I think the risk-adjusted returns are very good because when you get into one of these deals, it's like I feel like seriously you're not taking that much risk for how much you're making. So
I agree. I was looking at a deal yesterday, the same deal, right? And I was underwriting at 60% LTV, and just for funsies, right? I took a look at it with a refi in year 3 at 70% LTV and still like 5.5% rate, and that was going to be a good one, right? Yeah. And you know, I'm thinking back, we were talking through all this. I was having coffee with an investor of mine a year or so ago, and he's like, "This is a generational experience with rates this low, right?" And obviously, we know what's happened since then, but we had generational prosperity. And then we're having generationally high inflation, and kind of we're paying the penance for our exuberant spending for a long time, right? But when this comes through, I don't know if any of us going to be around for the next generation.
100%.
I mean, maybe Elijah. He looks like he's pretty young.
Yeah, well,
right?
he's eating all organic probably in the van.
Absolutely,
driving around to different farmers markets. But it's like you said, right? Like being contrarian. Being contrarian is so like to me, it always sounds like you're being rebellious, but really you probably just have more common sense than everybody else.
Yeah, it's common sense.
Yeah, if everybody else thinks it's a good idea, like every deal that we're in that was done at in the last few years. Those are the deals that we're going, we've got to pull out the stops to really keep them back on track and everything. The last deal that we just did in March, higher interest rate, we underwrote it that way, performing fantastically.
Yep.
And it's fixed debt. I mean,
Yes.
the last 3 years, people look a little bit. It's greed, right? It was greed in terms of getting the deal done and lowering their upfront costs to make sure the investor stuff worked, but. Ultimately, the last couple of years, the type of loan products they're getting, if you go back to 2008, that's the 2008 crash with the residential ninja loans, the no income, no job, no assets. This is essentially that in the multifamily space.
I do want your opinion on that too, Elijah. Like how we just, coming from the financial industry and working in the hedge fund space, you work with some of the brightest minds out there. Like how the fuck do we never learn? Right, like looking back, it's easy to be like, "Hey, there's a loan product that's legit." They didn't even try to hide what it was called. It's called no income, no job, money we'll give you, and we'll look back like that was fucking really dumb. And then we look at like, "Hey, that loan product that is supposed to be for like massive overhaul, insane capex." Why don't you just do that on like a Class A property, and like that'll work out. And then we look back, now we look back, we're like, we got this bridge debt crisis. We're like, fucking, of course you do.
Yeah, and then they're like, it's lower money down.
Yes, and it's just
less money down.
How do we do this?
People are getting desperate. I mean, the loan officers don't they're not making any sales. They're not making any points on these loans because nobody qualifies for the products that are out there. So now they're going down that dangerous trap of creating products that people will qualify for that are just riskier, and so that will always happen.
We talked to a lender recently who brought us a deal, and we love this guy, and he listens to the show, so this is not a slight against him, but we're all in the business of selling each other stuff, and sometimes we're just there's only bullshit out there to sell each other, right? And we're all trying to do our thing, and we got brought a deal that was like 8 different buildings, right? And that one. Yeah. And these guys had gotten into this deal. They were ranchers. They were not in the multifamily space, and they were way in over their heads. And a lender was a friend of ours pitching it to us, and had the financing lined up. And like at one point, he like casually mentioned like, I think there was a fire in one of them, and like Nick and I went to go visit it. It didn't exist anymore. No. Like one of the buildings had completely burned to the ground, and like just the way we were talking about things, so like there might be a little extra capex there, or like it's just a foundation.
Yeah,
there's not even a building anymore, and it was just like
the exaggeration.
The things we'll do to get deals done and in the environment. It's always funny how that works out.
So Elijah, as you're going through your capital raising and capital allocating activities right now, what are some of the objections that you're hearing from prospects as you approach them with opportunities?
Yeah, I think one of the big ones is going in basis. So a lot of sponsors right now are overpaying for assets according to the investors.
Yeah.
I heard someone laugh. Care to explain that one?
No, I think the investors are the buyers.
Yeah.
Right.
They are like, no, it's funny. Like
He's laughing because we have
matter-
this constant friction over what's the right price to offer, and no matter what it is, he always wants
no
it
matter
lower.
and no
Yeah.
matter what the price is, the investors will always say like, oh, like you should be paying less for that.
Right.
Yeah.
Come on.
Right.
Like who cares in like a 10-year time frame? Like stop it.
Thank
That
you.
was a good point.
Thank you.
That was a good point.
Thank you.
It doesn't matter. And so that's one of them. The other big thing is the debt. So like investors right now are really hesitant to get involved in deals that have short-term floating rate bridge debt. And so the sponsors that we're investing in, they're at least getting, 3-year caps at least on their bridge products with 5-year bridge loans. 3+1+1 is the term for it. But the debt is a big thing right now, just because it's all over the news, with sponsors getting in trouble and handing keys back to the bank and stuff like that.
Yeah.
I'd say those are the two biggest things right now.
Do you compete with money markets and CDs and stuff? Do people say, "Hey, I'm going to keep my money in this, JP Morgan 5% money market"?
No, that's like way lower down on the risk spectrum. So like what we do, I think to me it's lower risk, but to the investors, we're kind of like in the middle of the risk spectrum, whereas those products are like very low on the risk spectrum. For us, it's like medium risk, medium reward. You're taking more risk than if you put the money into like bonds or CDs or high yield savings accounts, but you're still taking less risk than going out and buying stocks or investing in a business. So it's kind of like right in the middle there.
Gotcha. And how do you so let me phrase this the right way. Are you going to your investor pool opportunity by opportunity, or are you more going at it from a fund perspective where you say, I'm looking for X dollars and my buy box is 8 to 9% annual cash on cash, overall returns of 100% and a high teens IRR?
Deal by deal. And the reason why we have to do it that way is because unless you have a significant track record, we've only done 22 deals. We have like 12 full cycle. Unless you have, like 100 deals and like 50 full cycle or whatever, it's really difficult to raise capital for, a blind discretionary fund where you're just kind of giving your investors, telling them what your mandate is, showing them a deck of what potentially you could invest in, and then hoping that that's very difficult to raise capital for. So currently we're just doing a deal by deal structure.
That makes sense.
Nice.
That makes sense. And how are you, you're talking about, we talk about the Dallas area, you look at deals here. How are you offsetting, risk as far as looking at different vintages and things like that? There's a lot of 60s and 70s product out there. Are you looking for enhanced returns just for that risk profile?
We're looking for only things 1980s and newer. So nothing older than 1980. And we want something with significant value add potential. So like one of the ways we protect ourselves from that risk is by renovating, 90 to 100% of the units and then raising the rents $400. And that gives us like a huge cushion in terms of value. I mean, right now, like what we aim to do is, double our investors' money within a 2 to 5 year period. And so to do that, we're doubling the value of the property. Yeah. And, when you raise rents $400, you can do that. And that provides a lot of equity cushion, which helps reduce the risk.
Yeah.
Yeah. Makes perfect sense.
So Elijah, like because now you're in that LP side of the world, right? So, and you're looking at the operators, the GPs. What is your checkoff list on that? Like in terms of obviously track record, but what else are you looking for than just their previous track record?
Yeah, I actually just came out with like a 45 question deal inspection thing that we're going to be doing for every deal to show the investors. But it really starts out with the sponsor and the trust. So the numbers are certainly extremely important, but like at the end of the day, the most important thing is whether or not we trust the sponsor and whether or not we have a good relationship with them. So that's like number one. I really care about a track record. I want to see, 5 to 10 or more full cycle deals where the rates of return crush the projections. I want to know that the sponsor is going to step in and save the day if something goes wrong before they come to me to ask me for more money. We call those capital calls. And so if the sponsor is like independently wealthy, the sponsor has 30, 40, $50 million, they can write a check before they come to me. And so that's really important as well. Those are just a few of kind of like the qualitative things. When we look for, on the numbers side, I'll do a very deep dive into the underwriting. I want to make sure that the expense ratios are appropriate, that the, projected returns fall within our targets, and that the assumptions used to come up with those returns are conservative. So that's those are just a few of the things that I'll look for when I do a deal. But it does take a while to evaluate sponsors, and usually I'll follow them for a year or two before I'll invest.
So 2 quick questions, right? Number one is, how do you evaluate track record now, right? Because there's been plenty of people that made their investors a lot of money when cap rates compressed from 7% to 4%.
And
right?
I was going to ask that, like, do you weigh it differently? Like over the last 3 years, they took something full cycle, but the last 3 years,
it was easy.
Let's be real. You didn't even have to show up, and it would still turn, and you could turn out a profit.
Definitely. So when I'm looking at these like full cycle deals, I want to see that they did like 2 or 3x their projections. And like the reason why is because the market was so hot that anyone who didn't do that, something might have been wrong. Like if you're only hitting a 20% IRR and you projected a 15% and the market was that hot, like you probably were going to lose money because you did a crappy job executing your business plan. But for someone who got, a 70 or 100% IRR, it's like, okay, wow, you actually went above and beyond and crushed it, even while the market was hot. So that's what I
love it. And then follow-up question to that is, so you talk about conservative assumptions, and this is something else that we kind of ruminate about is, is it 8% vacancy? Is it 10% vacancy? How do we stress test it? Is it 5.5% exit cap? Is it 6.5 exit cap? Are we underwriting for $700 a month or $700 per unit for R&M? And somebody on our call is like, I think it should be $850. Well, why? Well, I don't know. It should be. So how do you quantify conservative assumptions with all the deals that you look at?
Yeah, it's a good question. There's a lot of different, things we look at. I think one of the most important ones is the expense ratio. If you've got someone saying that their expenses are only going to be 20% of the total revenue, then that's kind of like not really conservative at all. I want to see something closer to 40 or 50%. It's market dependent. So that's one of the things in terms of like rent growth. Like right now, like you should be putting in 0% rent growth for the next 2 years. And then you shouldn't have anything higher than 3% for the remaining years, just because most of the investors who look at it will laugh at you if you have anything over 5%. And so it's things like that. Exit cap rate. So like the price you're going to sell at, you need to assume that you're going to sell it at a higher cap rate or a worse cap rate than what you bought it for. Stuff like that. So I'll go through the underwriting model with a fine tooth comb and really pick it apart and figure out, if the deal is underwritten conservatively.
I think it's safe to say that, and to make it really simple, is like the business plan should be dependent on your ability to operate the property and execute your business plan, not on the market to carry you forward. So if your business plan is dependent on rent growth and things like that to be executed, those variables, they're probably not going to come through for you.
Yeah.
Right. It needs to be a deal in basically a zero rent growth environment. And
don't throw random shit in like pet rent and like extra parking space income stuff that's just like completely random. That's just to juice it. Like that stuff's great. That's a bonus. That's freaking awesome. That's how you're going to exceed projections, but the deal should not be dependent on those things. things.
Yeah, assume those things aren't going to happen. That makes perfect sense.
Yeah, you only do that when you sell it, Brian.
Yes.
Yeah, you include that in the sale numbers.
Exactly.
Yeah.
That's in your OM.
Yeah.
Put it in it. Put it in a slide in the deck, but
Yes.
just say these numbers are not part of the underwriting.
Exactly.
Yeah, 100%. So as we get closer to wrapping this up, Elijah, what are you most excited about? Like everything's negative. You said, your investor, your potential future investors are just hitting you with objections left and right. What are you most excited about, over the next year? And then what is the follow-up question to that would be what is your growth trajectory for your company looking like over the next 36 months?
The deals are out there, baby. You just gotta go and get them. Yes. Raise the money. I mean, you can get 20-30% discounts right now. You're never gonna find deals like that the rest of your life. Go out there and find the deals. They're there. So that's what I'm excited about. We're finding deals all the time. We're working with awesome sponsors who are going out there and getting first bid on these properties off market. It's great. In terms of the trajectory of GoldHawk Capital, right now we're raising about $1 million a month for these deals. And, I would like to be in the $5 million a month range within a year from now. So essentially raising capital, allocating capital into deals, probably one deal per month, $5 million or so. So that's really what we're looking to do.
Love that, man. Elijah, where can people find you?
Yeah, our website's goldhawk.us, or if you want to get in touch with me, find me on LinkedIn, linkedin.com/in/Elijah W. Brown. I got a lot of good stuff on there, free products, underwriting models, ebooks, all kinds of shit. So find me on LinkedIn.
Awesome, man. Well, I appreciate it, dude. I know that you got a jet, but we really appreciate you taking the time, man. You got to cruise by in the van next time you're in Texas. We'll go out for drinks or something.
That would be awesome. You guys have been great. This was by far one of the most fun and professional podcasts that I have been on. So thank you.
I believe it, man. I appreciate it.
That's what they call us, fun and professional.
Exactly.
It's never professional and fun. It's always fun and professional.
Exactly.
So, Elijah, we truly appreciate it, buddy. And then everyone go to his website, goldhawk.us, correct?
Yeah, that's it.
goldhawk.us. And then, of course, you can go to the sponsor of this show's website, Deep Blue. So just go to deepbluere.com. And if you're wanting to start a podcast like this, if you're wanting to do more video marketing and build your brand, this is the best time to do so. So you can get with Jesse Showalter, our favorite producer, over at Tor Studios, TORE Studios.com, and just tell him to have him show you the beard.
Oh, yeah. Perfect.
Yeah. So, all right. Until next week.
Thank you, guys. Appreciate it. Episode 14 in the can. We'll see you then.